your basic finances are sorted, you can actually stay calm during market dips because you won't feel compelled to sell. You can ride out the volatility and let time do the heavy lifting for your investments. So, if you're currently paying down debt or building an emergency buffer, don't treat it as putting your investing on hold. Treat it as level one of your wealth building plan. Once your financial house is in order, you'll be ready to invest with confidence and remain invested long enough to see real results. Main step: define your goals and time horizon. Less than a third of investors have a clear long term goal, according to a survey of Ling investors by the FCA. And honestly, that's unsurprising. Many people start investing because it sounds like the right thing to do without pausing to ask why they're investing in the first place. They open an app, pick a few funds or a trending stock, and hope for the best. When markets wobble or a short term expense arrives, they sell. So, if I was starting from scratch today, the first question I'd ask is, what am I investing for? Early retirement? A house, world travel? Your goals determine the account type, the level of risk you can take, and how you cope with market swings. And think about timeframes when deciding what to keep in cash and what to invest. Short-term goals money you'll need within 5 years, e.g., okay, a house deposit or a big life event should remain in cash because investments can be bumpy in the short run. For medium and long-term goals, 5 years plus, invest the longer money stays invested, the more short-term volatility tends to even out and the better your chances of building real wealth. For example, from Sansa April, e-Senling RCS to e-Senling RCWO, I-1000, look back Luxalop invested in global shares grew to C-Pounds, Dubak Ishalok, while Wubak Bashabs held in cash rose to just E-Pounds Tibet ESRC over the same period, which is why long-term savings belong in investments. Menjas. We'll cover how to invest later in the video, but there's far more to this topic than sewer minutes allows. If you want to go deeper, I'm hosting a free live workshop on Seed January, Tianling Arsalu. I ran this workshop in November and over Sansawu, Ling people registered the follow-up survey. 500 Josalu said they felt much more confident about what to invest in and actually took action afterward. I'm running it again for free. Sign up at nischa.me.insinvest. I'll show you how to choose investments, how to accelerate returns, the single biggest mistake new investors make and how to avoid it, and how to calculate what you'll eventually need to live off your investments. Again, it's 500 e-byte free. Register at nischa.me.invest before doors close. Philippi quits. Okay, now step San, choosing an investment account. This is where most people get stuck. There are so many types of investment accounts that it's easy to fall into analysis paralysis. You'll start researching one option, then another, and before you know it, you've spent hours scrolling without actually opening an account. I get why investing looks intimidating from the outside, like something that requires a degree. In reality, once your financial foundations are set and your goals are clear, the next step is surprisingly simple. Open an investment account and put money in it. That's it. You don't need a finance degree or a job on Wall Street. Just take that first small step, and you'll be about 500 choices of the way to becoming an investor. The best part, you can do it in minutes from your phone. So, which account should you pick? The unpopular answer is it depends on your goals and where you live. Here's what I'd do if I was starting from scratch this year. First, if you're employed, maximize your workplace pension. The details vary by country, but many employers contribute, and there are tax advantages. If your company matches contributions, you must take full advantage. The downside is limited access to the money until retirement. So if you'll need the funds sooner, anything beyond the match may not be the right choice. If you're self-employed, use a private retirement account to get similar tax-efficient retirement savings, though you won't get employer contribution. Damned and next, open a tax-free or tax-advantaged investment account. Normally, investment gains, dividends, interest, or capital gains are taxable, but in a tax-advantaged account, that growth stays yours. which can make a huge difference long term. The specifics depend on your country. In the UK, it's a stocks and shares ISA. In Canada, it's a TFSA. If you live elsewhere, check whether your country offers a similar option. Those tax benefits materially boost long term returns. Bayan steps, start small, but be consistent. People are surprised how powerful this is. If you invest just EBET a month and earn an average annual return of back to Byfund to Sir, roughly the historical S&P, Wubat range over Sir to Ursa's years, you'll have more than EBAT Sisses ling after Sansa years while contributing only Sanchalo. Ling yourself, the rest is growth. That's compound interest. Your returns earn returns, creating a snowball that accelerates over time. If you want a deeper dive, there's a separate video that explains compounding in detail. To illustrate briefly, invest, ibai and it grows, bai from the ba in year 1, 2, ibai ling ba. You earned ba in year 2. Ibai ling ba grows another bai from the ba to about ibai ishaliot den lo si. Your money keeps working for you without new contributions. Repeat year after year, and the effect is dramatic. The problem is most people never get that far because they're afraid of making mistakes. In a Barclays survey, Bivendis sister Seuss of people said a lack of knowledge was the main reason they weren't investing. And Bivendis sister E said they were afraid of losing money. If that sounds like you, that's completely understandable. When you've never invested before, the stock market can feel technical, overwhelming, and intimidating. But if you start small, stay consistent, and most importantly, follow the next step, the chances of losing money over the long term are actually very low. That brings us to step 5, diversification. Step think of diversification like a balanced diet. Imagine one of your New Year's goals is to eat healthier. You wouldn't load your plate with only pasta, only salad, or just chicken. You'd mix things up so you feel full, energized, and get the nutrients your body needs. If you only eat one type of food, you'll feel unbalanced, sluggish, and struggle to reach your health goals. Investing works the same way. If your entire portfolio is made up of just one type of investment, like tech stocks or crypto, it might look exciting, but it's not balanced. When that one sector or company falls, your whole portfolio suffers. Diversification is the financial version of a balanced plate. You spread your money across different investments, so if one underperforms, others help keep things steady. And if I was starting from scratch today, I'd keep things very simple and use index funds. These are collections of investments that track an entire market, such as the S&P, WUBAC, which includes WUBAT of the largest companies in the US. Instead of betting on a single company, you're investing in all of them at once. Index funds make diversification easy and low cost. With one investment, you can gain exposure to hundreds or even thousands of companies across sectors like technology, healthcare, finance, energy, and more. That way, your results aren't dependent on one stock or one industry. You don't need to know which part will perform best. The winners naturally balance out the losers. Over time, that balance helps your wealth grow steadily without lying awake at night worrying about losing everything. Being dia step Lu, automate, and simplify. There's a famous saying that the secret to great investing is doing nothing. Fidelity once found that their best performing accounts belonged to people who had either forgotten they had them or had passed away. As strange as it sounds, investors who check their portfolios the least often tend to earn the most. That doesn't mean ignoring your investments completely, but it does show that less tinkering usually leads to better results. If I were starting today, I'd automate as much as possible by setting up a monthly transfer from my bank to my investment account right after payday before the money gets spent elsewhere. This does two powerful things. It keeps investing consistent without relying on willpower, and it removes emotion from the process. When markets fall, you don't have to decide what to do. The system keeps investing for you. That way, you avoid overthinking questions like whether now is the right time to buy or whether you should wait for the next election. When you automate investing, You don't have to think about it. Your money keeps working while you get on with life. Many platforms let you set up a regular investment plan into your chosen fund each month so you don't need to log in, overthink it, and talk yourself out of doing anything. I've linked a few of those platforms in the description below. Simplicity wins over time. The best investors aren't glued to charts or market headlines. They build a system that keeps them investing no matter what the market does. Automation lets you do exactly that consistently and quietly without the stress. Ben step, chi hati sepenti sasi ti chi. Learn to stay calm when the market drops. The stock market has crashed several times in the past, by years, and every time it has recovered and reached new highs. When it happens to you, though, you rarely see the big picture. You just watch your balance fall and panic. This long-term view, shown in a chart from Morningstar mapping more than a century of market history, covers events like the Great Depression, the dot-com bubble, the global financial crisis, and the COVID crash. Some declines wiped out more than half the market's value, but after each one, the market eventually bounced back, often higher. For example, one downturn took about surpad months to recover, while the COVID crash recovered in roughly 4 months, the fastest rebound on record. For new investors living through a crash, it can feel endless, but those who stayed invested after even the worst crashes saw their portfolios recover and grow many times over. Taliance. When you zoom out, those alarming red dips start to look like small speed bumps on a long upward climb. Early on, I panicked at every market drop and worried I'd made a huge mistake. Over time, I learned the market rewards patience, not panic. That's why the earlier steps matter so much: an emergency fund, clear goals, consistent contributions, and diversification give you the confidence to stay invested when others are selling. Mbina. So if I was starting from scratch today, that's exactly what I'd do. Get my financial house in order, define my goals, choose the right account, start small, diversify, automate, and most importantly, stay calm when things get messy. You don't need a six-figure salary or a finance degree to invest. You learn by doing. You'll make mistakes, but if you stay invested, keep learning, and focus on the long term, those mistakes won't define your results. If you found this helpful, check out my upcoming video on asset classes and how to build your ideal mix. Subscribe so you don't miss it, and share this with anyone thinking about starting their investing journey.